So in that case, Doug, what would be fair value for Google, for Alphabet? I mean, what price to earnings multiple would you ascribe, incorporating and assuming the benefits they get from AI?
I think something in the mid to high 20s is fairer. So from here, we could see another 20, 30% rally. It may take more than a year to get that multiple, particularly as we deal with higher interest rates. That is certainly a headwind to all growth stocks, all stocks really. But I think that to me is a fair multiple. It would put them more in line with a Microsoft, more in line with an Apple, and I think that's the right place for Google to be.
Is that really a problem for tech stocks, you think? Higher rates or higher rates for longer? Because you look at what they've done this year, it's been defying gravity and defying the logic that rates could hurt them.
It has been until really the last couple of months. You're right. The last couple of months, I think that narrative has changed a little bit. And we looked at this in some of our models, and for every 1% change in interest rates, it's about a 10% hit to equity valuation for the Mag 7 stocks. And if you look back a couple months to where these stocks more or less all peaked, most of them are down 10 to 12% from those peaks. Google and Meta are actually the two exceptions. They're down a little bit less than that. So I think that these stocks, they have defied gravity most of this year. I think gravity has caught up with them a little bit as rates have really aggressively moved higher. And I think if rates continue to move higher, it will be a gravitational pull for all these stocks, despite them being really amazing, high-quality companies.
That's an incredibly nice way of saying that they could get crushed. But I've got to ask you, because, I'm looking at your notes, and you're saying that you're one of the first firms to use generative AI to build investment strategies. And this completely piques my interest, because, this is one of the things that's really hot right now, and perhaps it even could potentially democratize, not just for the institutions and all that want to use it. Maybe some smaller funds can get a little bit of an advantage, but it democratizes it for retail investors in particular if it can be proven out as a concept. So how does it work for you? How are you utilizing, whether or not it's the construction of algorithms? Is it, conducting the applied mathematics that are required in terms of your stochastics and everything else to make those assertions? How are you actually deploying Gen AI to make these decisions?
We actually use off-the-shelf generative AI tools. We give them very specific prompts, very specific instruction sets about how we want them to craft portfolios for us. And then we use the portfolios that the AI outputs. We have a couple of strategies running right now at Deepwater. As you mentioned, we think one of the first firms to use generative AI to do that. And so far, it's super early, but the results have been promising. And so to your point about democratizing it, I think that there is a philosophical sort of evolution that needs to happen in terms of how people think about AI and investing. Because to date, I think most people, when they think about using AI to invest, they think about quantitative funds. They think about trading and high frequency trading and using the data power that AI can bring to trading. But we're really trying to teach AI to invest like Warren Buffett. I think that's a better process.